feel like a lot of new option traders maybe completely don't even understand, and there's nothing wrong with that. Or maybe it's just so confusing that looking it up and reading about it gives you a headache. It used to do the same for me. Don't worry, I am here. I will give you examples. Today I wanted to talk about Greeks. Now, this isn't about people from the country of Greece. This is about the different factors that go into determining option pricing. I don't know why they're called the Greeks. I'm sure you can look them up. Actually, I believe it's because of the letters that they use to name them. I wanted to make a story, but I'm not good like that. Look it up. But for what they are and what they do, watch this video. All right, let me go to my handy notepad and find it. Bam, the Greeks. Now, there's a bunch of different Greeks. We're going to talk about really the main four. Actually, most of them I'm going to discuss the main three because I would like to talk implied volatility in a different video. So let's just dive in. So the Greeks. The first one you're probably going to see or pay attention to, or I don't know, if you're new to it, you're not going to pay attention to any of them. But delta. You can see this on option chains, and the delta is the rate of change between the options price and a $1 change in the stock's price. Let me repeat that. It's the rate of change between the options price and a $1 change in the stock's price. So for call options, a delta is between 0 and 1, usually it's like 0.5, a number. And for put options, it's between -1 and 0, which it means it's telling you how much the option value, how much the option price is going to change if that option, if the underlying stock goes up or down $1. So it increases when it's in the money and it decreases when it's out of the money. I will get to examples and show you. The next one is gamma. Gamma is the rate of change between the option delta, which I conveniently just defined, and the stock's price. Gamma is highest at the money. So gamma is a second derivative because depends on, it affects the delta. The delta affects the price of the option. So if you want to think about it in a simple way, think about it as delta as speed of an option and gamma as acceleration of an option. The next one is very important, especially for option sellers, and that's time decay, theta. It's represented as a number between 0 and 1, and it tells you how much per day the option will lose in value as you get closer to the option's expiration date. Again, I'll give you examples. Just hang in there with me. But these are the main three I'm going to work with. Now, there's another one called Vega. I mean, there's Rho and all these other different ones. But let's stick with these four. There's Vega, which is the rate of change between an option's value and the stock's implied volatility. But I want to get into that in its own video because implied volatility is its whole thing. So let's stick with the Greeks right now. And I'm going to move this off to the side. And we'll go off the screen. And we'll go into an option. So we're looking at Ford right now, one of my favorite stocks. Let's go to the option chain and let's get some concrete examples. I know it's hard to see, so let's zoom in. Here we go. All right, so you can see at the very top of the screen here, I have the ask, bid, implied volatility. And then I got these, theta, gamma, delta, open interest, volume, mark. At some point, I'll explain literally what all of those means, but for this video, I just want to stick with delta, gamma, and theta. Now, the delta is the rate of change that an option's price will move based on a $1 move in the underlying stock. Great. What does that mean? Well, let's take a look at the at-the-money call option right now, which is the 11.50 call. It's currently trading for $11 by 12 cents. Well, it's not currently trading because the market is closed. So the delta on this, let me make sure you guys see it, the delta on this is 0.34. So that means everything else staying the same because option pricing all works together at all times. It's an algorithm. It's confusing, right? but everything's staying the same with the delta. That means that if Ford stock went from its current price of $11.25 and went up to $12.25, that this $11.50 option would increase in value by 34 cents, because delta is the rate of change in the option value based on a $1 move in the underlying stock. So if Ford goes up $1 to $12.25, then this option goes up in value 34 cents. I mean, currently that'd be like more than double, or what it is, almost triple what the current value is of the option. But that's what delta is telling us. And you can see on either side, we'll stick with the call side. I mean, you can see when you go in the money, the delta is 1, so that means you're moving 1 for 1. That's a nice return for that. And the delta goes down the farther out of the money we get. Now let's look at gamma. Gamma is the rate of change that the option delta will move given a $1 change in that underlying stock. And we'll stick with this $11.50 option, the call option on Ford. So right now, the stock is $11.25. If it were to go up $1 to $12.25, the gamma is telling us that is 0.72. So the gamma is 0.72. So if the stock goes up $1, then the delta would increase by 0.72. That's huge, because at that point, it's at the money. Remember, gamma is highest at the money, as you can see with the 0.72. And it just kind of starts to peter off when it goes into the money and out of the money. So, when you're buying, and this is why Kenny Glick likes at the money options. I mean, maybe not exactly because of gamma, but it helps the stock move most like helps the option move most like the underlying stock. Now, the last one I want to get to is theta right here. It says theta. And we're going to stick with the same option just to make it easy. So the 1150 call on Ford has a theta of negative 0.12. What the heck does that mean? Well, like I said with theta, that's the time decay. That's how much an option is going to lose in value every day until expiration. So this option, it expires June 17th, so this Friday. It's currently June 16th when I'm recording it. It expires tomorrow. So this option tomorrow, it's still pretty out of the money. It's, 35 cents out of the money. God, I hope that matters. It's 25 cents out of the money. That's basic math. I don't do math. Anyways, this theta decay, the time decay, is telling us that this option will lose 12 cents in value by expiration. The option's trading for $11 by 12. So basically, if everything else stays the same, if the stock price stays the same, if everything stays the same, this option will expire worthless, because in that one day that is left, the theta is going to burn off 12 cents in value, and it's currently only worth 11 cents by 12 cents. So these are the kinds of things that go into determining option prices. And you can see that theta decreases as we move in the money, and it also decreases as we move out of the money. So just to be sure, I want to bring up our definitions, right? I don't want to leave you without going over this again. So delta is the rate of change between the options price and a $1 change in the stock price. Ford goes up $1. Remember, that option would have gone up 34 cents. Gamma is the rate of change between the options delta and the stock price. So if that option had gone up if Ford had gone up $1, the delta would have increased by 72 cents. Theta is the time decay of an option, or how much value an option loses per day until expiration. The theta decay is negative 0.12 on this option, so it would lose 12 cents in value. All things staying the same, which they most likely won't. All things staying the same, this option would lose 12 cents in value by expiration, which is tomorrow. And lastly, Vega is the rate of change between the stock's option value and the stock's implied volatility. I'll get into that in a separate video because I'd like to talk more about implied volatility. But this is just a basic introduction into the Greeks and how they affect option pricing.